Listen to me. You have worked 30, 40, maybe 50 years for your money. You sacrificed. You saved. You skipped vacations, you put off buying that new car, and you crammed every single spare dollar you could find into your 401(k), IRAs, and brokerage accounts. And now, you're standing at the edge of retirement, or maybe you're already sitting in it, and you are terrified. You're terrified because nobody taught you the second half of the game. We spend our entire working lives learning how to accumulate wealth, but nobody tells us how to deaccumulate it without giving half of it right back to Uncle Sam. It keeps you up at 3 o'clock in the morning, doesn't it? You lie there asking yourself, which account do I tap first? If I pull from my traditional IRA, am I going to get slammed with income taxes? If I sell my stocks in my brokerage account, will capital gains eat me alive? What happens when required minimum distributions hit at age 73 or 75? You fear running out of money before you run out of life. And let me tell you something, that fear is real if you do this wrong. So stop, take a deep breath, and hear what I am saying to you today. You do not have to give your hard-earned money away to taxes if you get smart right now. When you enter retirement, you generally have 3 main buckets of money. Bucket number 1, taxable accounts, your individual or joint brokerage accounts, checking, and savings. Bucket number 2, tax-deferred accounts, your traditional 401(k), 403(b), and traditional IRAs. Bucket number 3, tax-free accounts, your Roth IRAs and Roth 401(k). The conventional wisdom that old-school financial advisors love to parrot is simple: draw down taxable accounts first, tax-deferred second, and touch your tax-free Roth last. And while that sounds neat and orderly, following that rule blindly can be a massive financial mistake. Why? Because if you drain your taxable accounts completely while ignoring your traditional IRA, that tax-deferred monster is compounding and growing bigger and bigger behind the scenes. Then, the minute you turn age 73 or 75, the IRS knocks on your door with required minimum distributions, RMDs. They force you to pull out huge chunks of money, shoving you into a higher tax bracket, taxing up to 85% of your Social Security benefits, and sending your Medicare premiums skyrocketing through IRMAA surcharges. That is a tax trap, my friends. So what is the smart, tax-efficient withdrawal sequence? First, every single year, you must manage your income tax bracket like your retirement depends on it, because it does. In those early retirement years, especially before Social Security kicks in and before RMDs start, your taxable income might be lower than it has ever been. Do not waste those lower tax bracket years. You want to fill up the lower income tax brackets intentionally. You pull from your traditional tax-deferred accounts up to the top of the standard deduction or the lower tax brackets. Second, you take advantage of partial Roth conversions during those low-income gap years. You move money out of your traditional IRA into your Roth IRA, paying the tax at today's lower rates so that money grows completely tax-free for the rest of your life and passes tax-free to your kids. Third, you coordinate your taxable account distributions. Remember that long-term capital gains rates are significantly lower than ordinary income tax rates, and if your taxable income is low enough, your capital gains tax rate could be 0%. And fourth, you save that beautiful Roth IRA for strategic moments and late retirement. When you need extra cash for a new roof, a medical emergency, or a big family trip, you tap the Roth. Why? Because pulling $10,000, $20,000, or $50,000 out of a Roth does not add one single penny to your taxable income. It won't push you into a higher bracket, it won't trigger Medicare surcharges, and it won't tax your Social Security. Your actionable takeaway starting today: pull out your tax returns and account balances. Do not treat your retirement money as one giant pot. Map out your 3 buckets: taxable, tax-deferred, and tax-free. Work with a tax-aware advisor to calculate your annual tax bracket room, defuse your future RMD tax bomb with early strategic IRA withdrawals and Roth conversions, and keep more of your money where it belongs, in your pocket. You earned it, now protect it.